Most people will never build real wealth, not because they are incapable, not because opportunities are scarce, but because they are solving the wrong financial problem. They believe the answer lies in earning more money. In reality, the answer lies in understanding how money behaves once you earn it. Income alone does not create wealth. Structure does. You can increase your salary, launch a side hustle, close high-paying deals, even hit six figures per year, and still remain financially fragile. Because if your financial system depends entirely on your effort, you have not built wealth. You have built pressure. The moment effort slows down, income slows down. The moment income slows down, lifestyle becomes stress. That is not wealth. That is dependency disguised as success. Look at your own financial life. When your income increases, what changes first? Your investments or your expenses? Do you allocate capital to assets automatically, or do you upgrade your lifestyle first and invest what's left? Most people invest leftovers. Wealth builders invest first and spend what remains. That single behavioral difference compounds into massive financial divergence over time. The real reason people feel financially stuck is deeper than income levels. It is structural behavior. They optimize for cash flow instead of asset control. They think in months instead of decades. They chase visible success instead of invisible compounding. And because of that, they remain active earners instead of becoming strategic owners. Money follows predictable mechanics. Income must be converted into productive assets. Productive assets must either appreciate or generate cash flow. That cash flow must be reinvested. Time must be allowed to multiply the system. Discipline must protect it from emotional decisions. Risk must be measured and managed. This is not motivational advice. It is financial physics. Most side hustles fail not because the idea is bad, but because the structure behind them is weak. Reselling, consulting, editing, trading, agency work. These can produce income, but income without asset conversion is temporary. If your side hustle only increases your spending power and not your ownership position, you are still trading time for money, just at a higher rate. The psychological trap is powerful. Spending feels immediate. Investing feels delayed. Buying something expensive creates instant validation. Building an asset produces quiet, invisible growth. Human nature prefers visible reward over delayed multiplication. That is why most people stay in the earn and spend cycle for decades. True wealth builders think differently. They treat income as fuel, not reward. Every dollar earned is assigned a strategic role. Some capital covers necessities. Some capital funds growth. Some capital acquires assets. Nothing floats aimlessly. Nothing moves emotionally. Every allocation strengthens the balance sheet. Assets are systems that generate value independent of your daily labor. Equity in a scalable business. Dividend-producing investments. Intellectual property. Automated digital infrastructure. Real estate with positive cash flow. Ownership stakes in growth-driven ventures. These structures detach time from income. That detachment is financial freedom. Liabilities, on the other hand, create fixed pressure. High recurring expenses. Consumer debt. Status-driven purchases. Obligations that require constant income maintenance. The more liabilities you accumulate, the less optionality you have. Optionality is underrated. It determines whether you can pivot, invest aggressively, or survive downturns without panic. Risk management is not about avoiding volatility. It is about preparing for it. Markets fluctuate, industries shift, economic cycles tighten and expand. Individuals who depend solely on active income are exposed. Those who build diversified asset bases absorb shocks. Resilience is engineered, not hoped for. Compounding is misunderstood because it feels slow. In the beginning, growth appears insignificant. Returns look small. Progress seems invisible. But compounding is exponential. It rewards consistency, not intensity. It favors discipline over excitement. Most people quit before the curve turns steep. Wealth builders stay long enough to experience acceleration. Leverage amplifies everything. Capital leverage allows you to multiply returns through investments. Labor leverage allows you to scale output through teams. Technological leverage allows automation. Media leverage scales influence and distribution. Those who understand leverage escape linear income growth. Those who ignore it remain tied to effort. The worker mindset focuses on earning more. The owner mindset focuses on owning more. The worker negotiates salary. The owner negotiates equity. The worker upgrades lifestyle. The owner upgrades assets. This identity difference is subtle but powerful. Over a decade, it creates completely different financial outcomes. Many people confuse looking rich with being wealthy. Luxury cars, expensive watches, designer lifestyles, these are consumption signals. Wealth is balance sheet strength. It is equity ownership. It is diversified income streams. It is low fixed pressure relative to income. It is the ability to operate without financial anxiety. Discipline is the foundation. Emotional decisions destroy capital faster than market downturns. Impatience leads to chasing trends. Fear leads to selling at losses. Greed leads to overexposure. Discipline creates stability across cycles. Stability allows compounding to function uninterrupted. Time is the ultimate multiplier. Starting early matters, but staying consistent matters more. Small, structured investments repeated for years outperform sporadic aggressive bets. Wealth rarely comes from a single event. It comes from repeated strategic behavior. Before engaging in any side hustle or investment, ask structural questions. Does this increase my ownership? Does this create scalable leverage? Does this strengthen my asset base? Does this produce reinvestable cash flow? If the answer is no, then it may produce income, but it does not build wealth on its own. At CAPITRO Mind, the objective is clarity, not hype, not shortcuts, not unrealistic promises. The focus is on understanding money as a system. When you understand the mechanics, allocation, leverage, compounding, risk management, financial growth becomes predictable. You do not need revolutionary ideas to build wealth. You need structural alignment. Income directed toward assets. Assets protected by discipline. Growth amplified by leverage. Time allowed to compound. This framework has created wealth for decades. It is not exciting. It is effective. The strongest financial realization is this: wealth is not determined by how much you earn, but by how much of what you earn you convert into productive ownership. That is the dividing line. That is where most people fall short. Stop measuring success by income milestones. Start measuring it by asset growth. Stop asking how to make quick money. Start asking how to build systems that generate money without your constant effort. Because financial freedom is not built through urgency. It is built through structure. If this perspective aligns with how you want to think about money, then this channel is built for you. Subscribe to CAPITRO Mind for disciplined financial strategy and long-term wealth mechanics. Comment below, I'm thinking long-term, if you are committed to building assets instead of chasing income. Your financial future will reflect the structure you choose today.